talk about a tax strategy that could potentially save you thousands of dollars in taxes during your lifetime. It is specifically for employees of companies who may have received employer stock in their 401k through profit sharing or ESOP, Employee Stock Ownership Plan accounts. Now, to be clear, many employees receive a 401k and purchase mutual funds in their account. However, what we are talking about today is when an employee also has stock of the company they work for in their 401k plan. Let's first review what happens to a 401k when an employee separates from service, either due to a job change or retirement. A 401k is a retirement plan offered by your employer. As the employee, you can put money in your account. And in some cases, the employer also puts money in your account through matching or profit sharing. Now, when you leave the company, you have the option to roll the money over into an IRA to continue the tax deferral. At some point, however, you will need to start taking distributions for retirement income or as mandated by the IRS. When you take money out of your IRA or 401k through withdrawals, the money becomes fully taxable at your income tax bracket the year in which you are taking it. You may also have other income sources such as Social Security or pension, which could make your tax bracket even higher. So here's where we can look at a strategy to possibly pay a lower tax rate on some of your 401k money. Who wouldn't want that? If you have employer stock in your 401k, by utilizing a provision in the Internal Revenue Code called NUA, or Net Unrealized Appreciation, the gains on the stock while you were working will only be taxed at the long-term capital gains rate. However, there are many rules that need to be followed to take advantage of this strategy. So let's look at how NUA works in action. Let's say that we have Bob, who worked for company XYZ, and over the years was given stock of the company in his retirement plan. So now Bob decides to retire and has $200,000 in his account of XYZ stock. If he were to cash it out or roll it over into an IRA, when he ultimately withdraws it, then he will have to pay taxes at his regular income tax rate. However, the cost basis of the XYZ stock is only $50,000. So under NUA provisions, he could potentially pay the long-term capital gains rate on the gain of XYZ stock of $150,000, which could potentially save him thousands of dollars in taxes. Now, to meet the requirements for NUA rules, there are 3 specific requirements that must be met. Number 1, the employer stock must be distributed in kind. The shares cannot be sold and then rebought. Instead, they have to be transferred direct into a brokerage account. Number 2, the entire balance of the retirement plan must be distributed in 1 year. This doesn't mean all of the stock needs to be distributed in kind, but it does mean that all of the assets in the account need to move out of the employer retirement plan. Number 3, the lump sum distribution must be made after a triggering event. This means it's either a death, disability, separation from service like retirement, or reaching age 59 and a half. Now let's look at the tax treatment at distribution and sale. So going back to Bob, let's say he utilizes NUA on his XYZ stock in his retirement plan. In this example, he would do an in-kind transfer of the shares to a brokerage account, and the cost basis of $50,000 would become immediately taxable at his current income tax rate the year in which he retires. If he is under 59 and a half, this is important, he could also incur a 10% penalty. However, the remaining $150,000 would then continue to grow tax deferred until he decides to withdraw it. When he does ultimately sell those shares, they are then taxed at his long-term capital gains rate. If there is a subsequent gain after he retires, he will pay either long-term or short-term rates on that gain depending on the holding period. If we look at income tax rates versus long-term capital gains rates, we can see that this strategy can potentially save us a lot of money in taxes. There are many considerations to make when evaluating whether a NUA strategy could be beneficial for you. Some of the factors to consider are, number one, your age and whether you will be subject to that 10% penalty. Number two, what the cost basis is of the employer stock. That is very important. Number three, your current and future tax brackets. Number four, your other income sources now and in retirement. Number five, your other portfolio investments. And number six, very important, your risk tolerance. There is not a simple answer whether a NUA strategy is right for you. If you have questions regarding NUA and would like to speak to a qualified professional, please contact our office and work with your tax professional. Thank you so much. I hope you found this video interesting. Have a wonderful day.